NIO stock is under pressure again today, trading around $5.22, down roughly 5% as we head toward the Monday, December 1st market close. And once again, the stock is flirting with that $5 psychological threshold that has become a key battleground for traders. This is shaping up to be a session where NIO looks less like a company trading on fundamentals and more like a stock caught in the crossfire of macro fear, Chinese equity sentiment, and broader weakness across the electric vehicle sector. So let's take a closer look at what is actually happening today, what is driving the move, and what this could mean for the next few trading sessions. The first and most immediate factor pulling NIO down today is the overall market environment. The broader indices are trading in the red, with risk-off sentiment spreading across tech, growth, and Chinese-American depository receipts. When the market shifts into a defensive mode like this, anything high beta tends to fall first and fall hardest. NIO unfortunately sits directly in the center of that risk spectrum, which makes it extremely sensitive to these macro swings. Even when nothing specific is happening with a company, NIO tends to amplify whatever direction the market is moving in. When the market is falling, NIO usually falls more. Today's session reinforces that pattern. Chinese tech and EV stocks as a group are selling off. Whether you look at Alibaba, XPeng, Li Auto, or JD.com, the whole sector is under pressure. And when the entire category is weak, NIO almost never escapes the gravitational pull. The company does not need bad news for its stock to drop. It simply needs the market to sour on Chinese equities, and that alone causes a chain reaction. That's a big part of what we're seeing today. Another factor weighing on NIO is lingering skepticism around the company's financial direction. Even though NIO has shown progress in narrowing losses and improving vehicle margins in recent quarters, the profitability question continues to hang over the company like a shadow. Investors are still waiting for NIO to deliver consistent margin improvement, sustained cost efficiency, and a clearer timeline for break-even. That uncertainty naturally grows stronger in a market environment where people are already nervous. When sentiment is fragile, long-duration companies with ongoing losses are often the first to get hit. It's not that NIO is doing anything wrong today. It's that the market is not willing to reward progress until it becomes undeniable. As a result, everything feels magnified. Strong delivery numbers don't lift the stock. Analyst upgrades barely move the needle. Operational wins get overlooked. But macro headlines, volatility, and fear? Those always seem to hit hard. Today's drop is also tied to technical factors. The $5 level has become a clear psychological and algorithmic trigger point for the stock. Whenever NIO approaches this range, traders start thinking about stop-loss levels, break of support scenarios, and the possibility of further downside. Algorithms also tend to react aggressively around round numbers, especially for stocks that have already been under heavy selling pressure. As NIO hovers near this threshold, the risk of automated selling increases, which can amplify downward momentum temporarily. But the flip side is equally true. If NIO manages to hold above the $5 mark, even by a thin margin, that level can become a base for short-term relief rallies or short covering spikes. That's why this zone is so important. The movements around this level are not just about price, they are about trader psychology. They reflect how people feel about risk, fear, and opportunity. And today, that psychology is more fragile than usual. Despite the price action, there are still some underlying positive trends that shouldn't be ignored. NIO's most recent months have included strong delivery numbers, approaching or breaking new records across several models. The company's ES6 continues to be a consistent performer, surpassing 300,000 cumulative deliveries. These are not the numbers of a company losing relevance. They are the numbers of a company still delivering strong demand in a highly competitive market. On top of that, NIO's strategy for 2025 and 2026 includes significant milestones that could eventually shift market perception. The Firefly brand's right-hand drive expansion opens entirely new markets. The upcoming Onvo brand targets the mid-market family segment, addressing a completely different consumer demographic. The battery swap network continues to expand globally, strengthening NIO's ecosystem moat. And the company is making progress on cost efficiency and vertical integration. These are big-picture developments that matter for long-term valuation, even if the stock isn't reflecting them yet. But without immediate catalysts or market optimism, those long-term positives get overshadowed on days like today. Right now, the story is short-term fear and macro uncertainty. Long-term strategy only becomes relevant when the market has enough stability to pay attention to fundamentals again. Until that point, NIO stock will continue to trade like a barometer for sentiment around Chinese EV stocks, rather than as a reflection of its actual business performance. As we move toward the market close, one of the most interesting angles to explore is whether NIO can hold the $5 range. This price area acts like a line in the sand. For traders, it represents a potential bounce zone, a place where risk becomes more defined and short-term opportunities might emerge if selling pressure fades. For long-term investors, it offers a moment to assess whether the market is overshooting to the downside due to fear rather than fundamentals. A compelling angle for today's video is to focus on the tension between fear and value. You could frame it as NIO fighting to defend a critical psychological level while the broader market drags everything lower. It's a moment where traders and investors alike are asking the same question: is this simply the market shaking out weak hands, or is it a sign of deeper stress? The answer depends on how you interpret today's macro environment and how you weigh short-term volatility against long-term strategy. It's also worth pointing out that days like today are often pivotal for sentiment. If NIO manages to stabilize in the low $5 range, that can set the stage for a short-term recovery once the market finds its footing. But if the stock breaks meaningfully below $5 with strong volume, that could trigger a new wave of selling from traders who are hoping for a bounce. The direction over the next day or two will matter. It will say a lot about how the market wants to treat risk as we enter the final stretch of the year. Heading into the close, the big message is this: today's drop is not about NIO failing operationally. It's about the market shifting deeper into risk-off mode, which disproportionately affects companies like NIO. The fundamentals haven't changed since last week, but the mood has. That mood is driving flows, and flows are driving price. This isn't about one day's performance. It's about a fragile market environment amplifying fear. And when fear dominates, stocks like NIO feel the impact first. As we wrap up the session, the question becomes whether the $5 zone holds into the close and whether traders treat this level as a potential stabilization point. With NIO's long-term strategy still intact and upcoming catalysts on the horizon, this moment is less about panic and more about understanding the dynamics behind the move. The company continues to execute. The stock is reacting to something else entirely. And that gap between execution and valuation is exactly what makes NIO one of the most polarizing stocks heading into the final months of the year.